Hey everyone, welcome back to Corporate Decoder. Today, Synchrony Financial SYF just filed their quarterly report for June 2026, and I'm seeing some interesting trends in their loan business and how they are managing their money. Quick note. This is not financial advice, just my take on public filings for educational purposes. Synchrony is a big player in the credit card and financing world, working with retailers to offer payment options. So let's dive into what this report tells us about their performance. First things first, let's look at their main business earnings. For the 3 months ending the 30th of June 2026, Synchrony's net earnings were $885 million. That is a bit lower than the $967 million they made in the same period last year. When we look at their net interest income after accounting for retailer deals and setting aside money for potential loan losses, it stayed pretty flat at $2,380 million for the 3 months ending the 30th of June 2026, compared to $2,383 million the year before. They set aside more money for potential loan losses though. For the 3 months ended the 30th of June 2026, the provision for credit losses went up to $201 million from $146 million a year ago. This means they are being a bit more cautious about the loans they've made. Now let's talk about their loan portfolio, which is their biggest asset. At the end of June 2026, their total loan receivables were $102.2 billion. That is up from $99.8 billion at the same time last year. This growth is partly because they acquired the Lowe's commercial credit card portfolio, which added $0.7 billion to their loans. Even though their loan book has grown, their past due loans are actually a little better. Over 30-day loan delinquencies as a percentage of period end loan receivables decreased slightly to 4.16% at the 30th of June 2026 from 4.18% a year earlier. That is a good sign that people are still generally paying back their loans. Their allowance for credit losses as a percentage of total loans also went down to 10.09% from 10.59% a year ago, which aligns with the slight improvement in delinquencies. Synchrony also relies heavily on deposits to fund its operations. At the 30th of June 2026, they had $82.8 billion in deposits. This is up from $81.1 billion at the end of 2025, showing that people are still trusting them with their savings. A significant portion of their funding comes from these deposits, which is generally considered stable and lower cost. They also have other ways of raising money like issuing notes. At the 30th of June 2026, they had about $7.5 billion in senior and subordinated unsecured notes outstanding. Now let's look at how well capitalized Synchrony is. For the company as a whole, their total risk-based capital ratio was 16.9% at the 30th of June 2026. This is well above the minimum required for capital adequacy, which is good to see. Synchrony Bank, their banking subsidiary, also looks strong. Their total risk-based capital ratio was 16.5% at the 30th of June 2026, which is also well above the regulatory minimums. They are considered well capitalized, which is crucial for a bank. Going back to their earnings for the 3 months ending the 30th of June 2026, interest income was flat at $558.3 million. This is an interesting point. While they have more loans out than last year, interest income didn't grow. This is explained by lower interest earned on their cash and debt securities, which is part of their liquidity portfolio. On the flip side, interest expense went down significantly. It fell by $90 million or 8.5% for the 3 months ending the 30th of June 2026. This is mainly because the cost of their borrowing went down thanks to lower benchmark interest rates. Their cost of funds dropped to 3.96%, which is a welcome relief compared to last year. Other income saw a nice bump up. It increased by $19 million or 16.1% for the 3 months ended the 30th of June 2026. This was boosted by a gain of $30 million from an exchange offer involving Visa stock, which is a one-time boost. However, other expenses are on the rise. They increased by $86 million or 6.9% for the 3 months ended the 30th of June 2026. This is mainly due to higher operational losses and increased spending on technology investments. It seems they are investing heavily in their tech infrastructure. Looking at specific business areas, the purchase volume, which is the total amount customers spent using their cards, increased. For the 3 months ending the 30th of June 2026, purchase volume was $49.8 billion, up from $46.1 billion a year ago. This shows continued customer spending activity through Synchrony's partners. The number of active accounts has stayed pretty steady. They had about 68.4 million average active accounts during the 3 months ended the 30th of June 2026, roughly the same as last year. So what is the story here? Synchrony is growing its loan book while keeping delinquencies largely in check. They're benefiting from lower borrowing costs but are facing rising operational expenses likely due to investments in technology. The company is also actively managing its capital. They repurchased $1.8 billion of their own stock in the first half of 2026 and paid out dividends, showing a commitment to returning value to shareholders. It is worth noting how they handle borrowers in financial trouble. At the 30th of June 2026, they had about $541 million in long-term and short-term loan modifications. This shows they are working with customers who are struggling though. These modifications represent a small portion of their total loan portfolio. In terms of credit quality indicators for their credit card customers, 74% have a credit score of 651 or higher, which is considered strong credit. This indicates a generally healthy customer base. Overall, Synchrony appears to be navigating the current economic landscape reasonably well with solid deposit growth and controlled delinquencies. The increased spending on technology and managing operational costs will be key to watch as they continue to grow. The risk I am watching is how these technology investments translate into future growth and efficiency. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.